One of the ways to save money on taxes with this pandemic-era loophole is to use a like-kind exchange. A like-kind exchange, also called a 1031 exchange, is a tax-deferred transaction that allows you to exchange real property used for business or investment for another property of the same type or like kind. This way, you can avoid paying capital gains tax and depreciation recapture tax on the sale of the first property. A like-kind exchange applies only to real property and not to other assets like artwork or heavy equipment. The properties exchanged must be held for productive use in a trade or business or for investment purposes. They do not need to be similar in grade or quality, but they must be of the same nature or character. For example, you can exchange an apartment building for another apartment building, but not for a farm or a personal residence. To qualify for a like-kind exchange, you must meet certain requirements and report the transaction to the IRS using Form 8824. You must identify the replacement property within 45 days of selling the first property and close on the purchase within 180 days. You must also use a qualified intermediary to hold the proceeds from the sale until they are used to buy the replacement property. If you receive any cash or other property that is not like-kind as part of the exchange, you must recognize a gain to the extent of the cash or other property received. A like-kind exchange is a powerful tool for real estate investors who want to defer taxes on their gains by reinvesting them in similar properties. By using this pandemic-era loophole, you can save money on taxes and grow your wealth through real estate. One of the most controversial aspects of President Biden's tax plan is his proposal to limit the tax deferral benefit of 1031 exchanges for real estate investors. A 1031 exchange is a provision in the IRS tax code that allows investors to sell one property and buy another of similar value without paying capital gains tax on the sale. This way, investors can defer paying tax until they sell their final property or pass it on to their heirs. Biden's proposal would cap the amount of deferred gain at $500,000 for single taxpayers and $1 million for married taxpayers. This means that any gain above these thresholds would be subject to tax at the time of the exchange. The proposal would only apply to taxpayers earning more than $400,000 a year. The administration argues that this change would raise revenue and make the tax system more fair by closing a loophole that benefits wealthy real estate investors. According to the White House, 1031 exchanges cost the government about $41 billion in lost revenue over 10 years. However, critics of the proposal say that it would hurt the real estate market and the economy by discouraging investment, reducing liquidity, lowering property values, and slowing down development. They claim that 1031 exchanges are not a loophole, but a legitimate tool for preserving capital and reinvesting in communities. Some of the potential impacts of limiting 1031 exchanges are less incentive to sell and buy properties. Investors who use 1031 exchanges often sell properties that are underperforming, outdated, or in need of renovation and buy properties that are more productive, modern, or in higher demand. This creates a dynamic market that stimulates transactions, generates commissions, creates jobs, and improves neighborhoods. If 1031 exchanges are limited, investors may hold on to their properties longer or sell them at a lower price to avoid paying tax. Less capital available for investment. Investors who use 1031 exchanges can leverage their equity to buy larger or more properties without reducing their cash flow. This allows them to diversify their portfolio, increase their income, and create more wealth. If 1031 exchanges are limited, investors may have less cash available for reinvestment after paying tax or may have to borrow more money to finance their purchases. Less demand for commercial and multifamily properties. Investors who use 1031 exchanges often buy commercial or multifamily properties that have higher returns and growth potential than residential properties. This creates demand for these types of properties and supports their values. If 1031 exchanges are limited, investors may shift their preference to residential properties that have lower tax rates, or may exit the market altogether. Less development and renovation of properties. Investors who use 1031 exchanges often buy properties that need improvement or development and add value to them through renovation, expansion, or conversion. This enhances the quality and supply of real estate and benefits tenants, consumers, and communities. If 1031 exchanges are limited, investors may have less incentive or ability to undertake these projects, or may pass on the costs to renters or buyers. One of the best ways to save money on taxes with this pandemic-era loophole is to take advantage of the like-kind exchange. A like-kind exchange is a tax-deferred transaction that allows you to swap one investment property for another similar one without paying capital gains tax on the sale of the first property. This way, you can defer your tax liability until you sell the replacement property or do another like-kind exchange. But how can you make sure you qualify for this tax-saving strategy? Here are some tips on how to take advantage of the like-kind exchange before it expires or changes, such as finding qualified intermediaries, identifying replacement properties, and meeting deadlines. First, you need to find a qualified intermediary to facilitate the exchange. A qualified intermediary is a third party who holds the proceeds from the sale of your relinquished property and uses them to purchase the replacement property on your behalf. You cannot use your own agent, attorney, accountant, or relative as a qualified intermediary. You also cannot receive or control the proceeds from the sale of your relinquished property, otherwise you will lose the tax deferral benefit. Second, you need to identify the replacement property within 45 days of closing on the sale of your relinquished property. You can identify up to 3 potential replacement properties of any value, or more than 3 properties as long as their total value does not exceed 200% of the value of your relinquished property. You must provide a written identification of the replacement properties to your qualified intermediary or another party involved in the exchange. Third, you need to close on the purchase of the replacement property within 180 days of closing on the sale of your relinquished property, or by the due date of your tax return for the year of the exchange, whichever is earlier. You must acquire substantially the same property that you identified within the 45-day period. If you fail to meet these deadlines, you will have to pay tax on the gain from the sale of your relinquished property. Finally, you need to make sure that both your relinquished and replacement properties are real estate held for investment or business purposes and are of like kind. Like kind means that they are of the same nature or character, even if they differ in grade or quality. For example, you can exchange an apartment building for a farm, but not for a personal residence or a piece of artwork. The new law that took effect in 2018 limits the like-kind exchange to real estate only, so you cannot exchange personal or intangible property anymore. By following these tips, you can take advantage of the like-kind exchange and save money on taxes with this pandemic-era loophole. Remember, this is a complex tax matter, and you should consult a professional before making any decisions. I hope this video was helpful and informative. If you liked it, please give it a thumbs up and subscribe to my channel for more tips on how to save money on taxes. Thanks for watching and see you next time.